My name is Margaret Campbell, and I have an urgent warning. Millions of Canadian seniors are unknowingly sabotaging their financial security with an action that feels responsible, but is, in fact, a hidden trap. Imagine this. You've worked your whole life, paid your bills, and now, to simplify things, you decide to close that 25-year-old department store credit card you never use. It feels like good housekeeping. What you don't know is that you may have just cost yourself thousands of dollars. That single action can send a shockwave through your credit score, damaging it at the precise moment you might need it most. Many believe that once you retire, your credit score retires too. This is a dangerous myth. Whether you're looking to downsize your home, get a premium travel card with essential medical insurance, or even co-sign a loan for a grandchild, your credit score is the silent gatekeeper. A mistake today can lock doors you don't even know you'll need to open tomorrow. For years, I've seen hardworking Canadians do everything right. You saved, you invested, you built a life. But now, in retirement, you're facing a new set of rules, and nobody from the banks or credit bureaus is handing you the playbook. I have dedicated my career to being a financial advocate for seniors, a guardian against the confusing fine print and the costly assumptions the system makes about you. My purpose is to pull back the curtain and give you the straight goods, the knowledge that financial institutions assume you already possess. Today, we're tackling one of the most misunderstood parts of retirement finance. I'm not here to talk in jargon. I'm here to expose the number one mistake that could be quietly draining your savings and to give you the simple, actionable steps to ensure you keep the financial power you've rightfully earned. Stay with me, because what you're about to learn goes against everything you think you know about being debt-free. My name is Margaret Campbell, and I am your senior's financial guardian. I've dedicated my career to one thing: being a fierce advocate for Canadians navigating the often confusing financial landscape of retirement. I am not a banker, and I don't work for the government. I work for you. My specialty is translating the mountain of bureaucratic jargon from institutions like the Canada Revenue Agency, Service Canada, and the credit bureaus into plain, actionable language. The system is passive. It assumes you know all the hidden rules, from how your CPP and OAS entitlements are calculated to how your credit score is secretly judged in your later years. They will not call you when a rule changes or when you make a simple mistake that could cost you money. I am here to be the one who makes that call. My mission is simple: to serve as your shield against financial loss and to ensure not $1 of your hard-earned money is left on the table. Whether it's understanding the nuances of the OAS clawback, maximizing your GIS benefits, or, as we're discussing today, protecting your creditworthiness, these are not just numbers on a page. They are the foundation of your security and your peace of mind. You've done the hard work of building your life. My job is to help you protect it. Think of me as your lookout, the one who reads the fine print so you don't have to, ensuring you have the knowledge and the power to control your financial future with absolute confidence. In the next few minutes, we are going to build your defense plan. This is your roadmap to financial protection. First, I will show you the 3 surprising ways your credit score is still a powerful, money-saving tool in your 60s, 70s, and beyond, from unlocking equity in your home to saving thousands on essential travel insurance. Second, we will do a deep dive into the single biggest mistake that is likely hurting your score right now, the one that goes against a lifetime of common sense. This is the heart of our discussion today. And third, I will give you a simple, no-cost checklist of actions you can take immediately to protect and even improve your score for good. You will walk away from this video with a clear understanding and a concrete plan, transforming any anxiety you may have into confident control. The information I'm about to share is vital, but the financial system is constantly changing its rules, and you can't afford to be left behind. To guarantee you're always one step ahead, and to ensure you never miss a critical update that could impact your savings or your family's security, please take a moment right now to subscribe to the channel and click that notification bell. It's a simple click, but it acts as your first line of defense, a personal alert system ensuring that this kind of essential knowledge always reaches you first. It's the most important, no-cost investment you can make today in protecting your financial future. Now, let's begin with why this all matters so much. Let's get specific. Why does this number still matter so much? First, and most importantly for many, it's about your home. Statistics Canada data shows that a significant number of Canadians in their late 50s and early 60s are still carrying a mortgage. Let's say you and your spouse, Robert and Diane from Halifax, decide it's time to downsize. Or perhaps you want to access your home's equity through a home equity line of credit, HELOC, to fund your travels or help a child with a down payment. Your credit score is the first thing the lender will look at. A drop of just 50 points from an excellent 780 to a good 730 can be the difference between a prime interest rate and a standard one. On a $200,000 HELOC or mortgage, that could easily cost you an extra $10,000, $20,000, or even $30,000 in interest over the life of the loan. It's a silent tax you pay for having a weaker score, draining money directly from the nest egg you worked so hard to build. Second, your credit score is your passport to a more secure and affordable retirement lifestyle, especially when it comes to travel. Are you one of the millions of Canadian seniors who head south for the winter or enjoys exploring the world? Many premium credit cards, like the top-tier travel rewards cards, offer comprehensive out-of-province and international travel medical insurance as a built-in perk. This benefit alone can be worth thousands, as purchasing standalone coverage for a 3-month trip can cost anywhere from $800 to over $2,000, depending on your age and health. But here's the catch the banks don't advertise. You need an excellent credit score, typically 760 or higher, just to be approved for these cards. A strong score isn't about getting into more debt. It's about unlocking access to essential money-saving benefits that protect you when you're most vulnerable. It's the key to making your retirement dreams a reality without paying a fortune for peace of mind. Finally, the impact of your credit score extends far beyond mortgages and travel perks. It has quietly woven its way into the fabric of our everyday expenses. Many insurance companies in Canada now use a credit-based insurance score to help determine your premiums for home and auto insurance. A lower score can translate directly into a higher annual bill, another slow leak in your fixed income budget. Thinking of getting a new mobile phone plan? A poor credit history might mean you're asked for a significant security deposit. The system sees your score as a measure of your overall financial responsibility, and it rewards or penalizes you accordingly. All these benefits, lower interest rates, critical insurance coverage, everyday savings, are within your reach. But they can all be put in jeopardy by one single common-sense action that most people believe is the right thing to do. In fact, this one mistake is the most destructive thing you can do to your credit in retirement, and I'm about to show you exactly what it is. Here is the single most destructive mistake I see seniors make, and it comes from the very best of intentions. It is closing your oldest credit card. Let's say you have a department store card, perhaps from the Bay or Canadian Tire, that you've held for 30 or even 40 years. You've paid it off diligently your entire life, and now, in an effort to tidy up your finances, you think, I don't need this anymore. I'll close it and simplify my wallet. In that single, well-meaning moment, you have just torn out the foundation of your financial house. A huge part of your credit score, up to 15%, is determined by the length of your credit history. By closing that 30-year-old account, you've just erased your most powerful piece of evidence, proving you are a reliable, long-term credit user. The average age of your accounts plummets, and to the credit bureaus, you suddenly look like a less experienced and therefore riskier borrower. But the damage doesn't stop there. The same action delivers a second, equally devastating blow to your score by wrecking your credit utilization ratio. This ratio is simply the amount of credit you're using compared to the total amount of credit you have available, and it accounts for a massive 30% of your score. Let's look at Arthur from Winnipeg. He has that same 30-year-old card with a $10,000 limit and a zero balance. He also has a newer card with a $5,000 limit, on which he carries a $2,500 balance for a recent purchase. His total credit is $15,000, and his utilization is a healthy 17%, $2,500 used out of $15,000. But when Arthur closes the old card, his total available credit drops to just $5,000. Suddenly, his utilization ratio skyrockets from 17% to 50%. Overnight, he's gone from looking like a responsible manager of credit to someone who appears to be maxing out their cards, a major red flag for any lender. This double impact, a shortened credit history and a spiked utilization ratio, can send a strong credit score tumbling by 50, 70, or even 100 points. The consequence is brutally real. When Arthur later applies for that HELOC to help his granddaughter, he's either denied outright or offered a rate a full percentage point higher, costing him thousands over the years. And this is the cruelest part of the common sense trap. The system is entirely passive. The bank that issued the card won't warn you about the consequences of closing it. Equifax and TransUnion won't send you an alert. The damage happens silently, behind the scenes, a direct result of an action you took to be more financially responsible. This is precisely why you must be your own guardian, armed with the knowledge that the system assumes you already have. Your lifetime of fiscal prudence can be undone in a moment if you don't understand these hidden rules. So how do you fix this and protect yourself from falling into this trap? It's far simpler than you think. Here is your 3-step action plan to forge your financial shield. First, and this is the most critical takeaway from today, do not close your oldest credit cards, especially if they have no annual fee. They are the bedrock of your credit history. The best thing you can do is use them for a small, recurring charge, like a coffee or a streaming subscription, and set up an automatic payment to pay it off in full each month. This keeps the account active and working for you, reinforcing your long history of reliability. Second, you must become your own watchdog. Go to the official websites for Equifax Canada and TransUnion Canada and request your free annual credit report. Check it for mistakes, errors, or any accounts you don't recognize. With financial fraud against seniors on the rise, this simple, no-cost action is absolutely non-negotiable for protecting your assets. The third step is about active management. Always keep your credit utilization low. This is the golden rule that signals financial control. The target you should always aim for is to use less than 30% of your available credit on any card at any given time. If your limit is $10,000, you should make a point to keep the balance below $3,000. To see how this plays out in the real world, let's look at a couple I consulted with, John and Susan from Calgary. They wanted to help their son with a down payment and looked into getting a home equity line of credit. The year before, John, thinking he was being tidy, had closed 2 old credit cards he'd had since the 80s. Susan, on the other hand, had kept hers open. When they applied, John's credit score had dropped to 680. Susan's, however, was a robust 790. The consequences for John and Susan were immediate and costly. Because the bank based the application on John's weaker score, they were offered an interest rate that was nearly a full percentage point higher than what they would have received with Susan's score alone. On the amount they needed to borrow, this single difference translated to an extra cost of thousands of dollars each year, money that was leaking directly out of their retirement income, all because of a simple, well-intentioned mistake. This is the difference between being a passive victim of the system and an active guardian of your own wealth. The knowledge you have now, to keep old accounts open, to monitor your reports, and to manage your balances, is the power you need to ensure you are always in the driver's seat, keeping your financial future secure and your hard-earned money in your own pocket. Let's bring this all home. The system isn't going to send you a warning letter before your credit score drops. It's up to you to be your own advocate. But the good news is, you now know exactly what to do. Remember the 3 fundamental truths from today. 1. Your credit score is not a relic of the past. It is a vital tool that saves you real money on everything from your home to your travel in retirement. 2. Closing old credit cards, no matter how sensible it feels, is the single fastest way to damage that tool. And 3. A few simple, no-cost habits, keeping old accounts active, monitoring your free reports, and keeping your balances below 30% are your impenetrable defense. You've worked too hard for too long to let a hidden rule undermine your financial security. You are now armed with the knowledge to stop that from happening. If this information has been valuable to you, please click the like button and subscribe to the channel. It costs you nothing, but your click acts as a signal, helping this video reach another senior who might be about to fall into this very trap. It's how we look out for one another. I am Margaret Campbell, your senior's financial guardian. Never forget that you have the power to protect your wealth and your family's future. Take control, stay vigilant, and ensure your retirement is everything you deserve it to be.